Hey guys, welcome back to another episode. Candlestick patterns are one of the most important factors when it comes to trading successfully, yet you'd be surprised that the majority of traders use candlestick patterns incorrectly. In this video, we're going to show you everything you need to know about trading candlestick patterns from beginning to end. Now, there is a massive, highly detailed candlestick patterns trading guide that works in combination with this video and is required to fully grasp these advanced concepts. We'll discuss how you can get this later in the video. So, in order for us to keep producing these videos for free, we need your support by hitting the like button, subscribing, and turning on the notifications bell. Now, here's exactly what we will be covering in this video. So, let's get right into it. We're going to first do a quick recap of the candlestick basics to get all the new people here on the same page. First, how to read candlesticks. You have your green candles, which are bullish. You have your red candles, which are bearish. This here is the candle body. These here are the candle wicks. For green candles, the opening price is at the bottom here, and the closing price is at the top here. For red candles, the opening price is at the top here, and the closing price is at the bottom here. The wick ends at the top represent the highest price point. The wick ends at the bottom represent the lowest price point. So, why are candlesticks important to understand? The candlestick pattern that forms acts as a leading indicator that tells you exactly what is occurring in terms of the buying and selling within the market at that particular moment in time, which then helps give you a directional bias to trade in. So next, how do we use candlestick patterns? Many traders will take trade entries solely based on what candlestick pattern forms on its own, which results in low quality trades. What we like to do is combine candlestick patterns with key levels and areas of confluence to increase the quality of the trade. And the higher the trade quality, the higher the percentage chance of success. So now, let's dive into the exact candlestick patterns we use. Now, there are a multitude of candlestick patterns that traders use, but these are the ones we find the most effective and that occur the most often. Let's start with the first, which is the long wick candle. This is any candle where the wick is sticking out in the same direction as the moving trend. Now, there are two variations of the long wick candle that make it of higher quality. First, the smaller the body of the candle, the better the candle. And second, the longer the wick, the better the candle, also known as a very long wick candle. So let's now show how this is used in combination with key levels. Starting in an uptrend, first, price came up, hit and reversed, giving you your key level of resistance. As price came back up, you had a perfect long wick candle form right at the key level of resistance, which presented a trade opportunity short. So what is the price action psychology behind this pattern? Buyers tried to push price higher, but they failed to close it out with momentum during that initial push, causing the wick to stick out. If they closed with momentum, then the candle should have looked like this, which is a momentum candle. The long wick candle forms through a combination of buyers taking profit at the key level, as well as sellers stepping in and opening new short positions at the level. This double action of buyers closing long positions and sellers opening short positions causes price to stall and react to the key level within that particular moment in time. Now, going in the opposite direction. Price came down, hit and reversed, giving you a key level of support. As price came back down, you had a perfect long wick candle form right at the key level of support, which presented a trade opportunity long. So what is the price action psychology behind this? Sellers tried to push price lower, but they failed to close it out with momentum during that initial push, causing the wick to stick out. The long wick candle forms through a combination of sellers taking profit at the key level, as well as buyers stepping in and opening new long positions at the level. So next, multiple long wick candles. So exactly like the name of it states, this is where you have multiple long wick candles clustered together. Now on the charts. Starting in an uptrend, price came up, hit and reversed, giving you a key level of resistance. As price came back up, you had multiple long wick candles form at the key level, which presented a trade opportunity short. So what is the price action psychology behind this pattern? This shows that buyers tried over and over again to breach the resistance level, 4 attempts in total to break through, but failing, showing that sellers held the level strong and that the level is valid this time around. Now, going in the opposite direction. Price came down, hit and reversed, giving you a key level of support. As price came back down, you had multiple long wick candles form at the key level, 3 in total, which presented a trade opportunity long. So what is the price action psychology behind this pattern? This shows that sellers tried over and over again to breach the support level, 3 attempts in total to break through, but failing, showing that buyers held the level strong and that the level is valid this time around. So next, the inverted long wick candle. The inverted long wick candle is a lot like the traditional long wick candle, except the wick sticks out in the opposite direction of the moving trend direction. Now, on the charts. Starting in an uptrend. First, price came up, hit and reversed, giving you a key level of resistance. As price came back up, you had the inverted long wick candle form right at the key level of resistance, which presented a trade opportunity short. So what is the price action psychology behind this pattern? Once price got to the level, you had strong selling presence that entered the market immediately within that particular moment in time, causing the wick to stick out below and against the moving uptrend, and validates that the level is in play and respected this time around. Now, going in the opposite direction. In a downtrend, price came down, hit and reversed, giving you a key level of support. As price came back down, you had the inverted long wick candle form right at the key level of support, which presented a trade opportunity long. So what is the price action psychology behind this? Once price got to the level, you had strong buying presence that immediately entered the market within that particular moment in time, causing the wick to stick out above and against the moving downtrend. So next, the inside bar candle. This is where the high and the low of the candle are contained within the high and the low of the previous candle. Now on the charts. Starting with an uptrend. First, price came up, hit and reversed, giving you a key level of resistance. As price came back up, you had the inside bar pattern form right at the key level of resistance, which presented a trade opportunity short. So what is the price action psychology behind this pattern? Price failed to make a higher high candle, which shows a loss of momentum from the buyers in the market and is an early signal of buyers no longer being in complete control of the moving trend direction. Now, going in the opposite direction. Price came down, hit and reversed, giving you a key level of support. As price came back down, you had the inside bar form right at the key level of support, which presented a trade opportunity long. So what's the price action psychology behind this? Price failed to make a lower low candle, which shows a loss of momentum from the sellers in the market and is an early signal of the sellers no longer being in complete control of the moving trend direction. Now, before we continue, we have a very important question we need you to answer. Do you prefer videos with a white background, like the one we are using in this video, or would you prefer a black background, like the ones we use in all our past videos? Comment below right now and tell us which background color you prefer. Also, if you're enjoying this video, please hit the like button, subscribe, and turn on the notifications bell so that you know exactly when we release new content. The last thing, make sure you go follow our Instagram account at WiseTrade to stay notified about a lot of big projects we have on the way. So next, consecutive shrinking candles. This is where you have consecutive candles that shrink in size. Notice how every candle gets smaller and smaller. Now on the charts. Starting with an uptrend, price came up, hit and reversed, giving you a key level of resistance. As price was approaching the key level, notice how the candles get smaller and smaller in size. Now this pattern works best when it also forms a reversal candlestick pattern once price reaches the level, such as a long wick candle like this. This isn't required, but when you have this combination, it will increase the quality of the setup. So what is the price action psychology behind this pattern? It shows a loss of momentum from the buyers in the market because the distance traveled per candle is shorter and shorter and is an early signal of the buyers losing control and momentum of the upwards trend direction. Now going in the opposite direction. Price came down, hit and reversed, giving you a key level of support. As price starts approaching the key level, notice how the candles get smaller and smaller in size, which presents a trade opportunity long. Again, notice how the shrinking candles finish with multiple long wick candles, which increases the quality of the trade setup. So what is the price action psychology behind this? It shows a loss of momentum from the sellers in the market because the distance traveled per candle is shorter and shorter and is an early signal of the sellers losing control and momentum of the downwards market direction. So next, consecutive candles increasing in size. This is where you have consecutive candles that get larger and larger in size. Now on the charts. Starting in an uptrend, you first need to identify a short trade setup at resistance. Now, some traders will take a short trade right after the long wick candle forms here, which is fine. But a more secure entry is to wait for this candle pattern to form, where the candles get larger and larger. Then, you would take a continuation trade short. So, what is the price action psychology behind this pattern? The pattern confirms that heavy selling presence has actually entered the market after the trade setup, because it shows a gain of bearish momentum from the sellers as the distance traveled per candle increases, meaning you can use the pattern as a trend change confirmation. Now going in the opposite direction. You first need to identify a long trade setup at support. Now, right after the long opportunity setup occurs is when you would look for this pattern to form, where the candles increase in size one after the other. So what is the price action psychology behind this? The patterns confirm that heavy buying presence has actually entered the market after the trade setup because it shows a gain of bullish momentum from the buyers as the distance traveled per candle increases. So next, the candle color change. This is where you have consecutive candles all of one color before an opposing color finally presents itself. Now on the charts. Starting with an uptrend. First, price came up, hit and reversed, giving you a key level of resistance. As price starts approaching the key level, notice how you have all green candles before a red candle finally appears. Now, this pattern works best when it also forms a reversal candlestick pattern once it reaches the level. This isn't required, but when you have this combination, it will increase the quality of the setup. So, what is the price action psychology behind this pattern? The consecutive green candles shows a continuation of buying presence before a red candle appears, which then shows a loss of momentum from the buyers as price failed to close the candle with a higher candle close. Now, going in the opposite direction. Price came down, hit and reversed, giving you a key level of support. As price starts approaching the key level, notice how you have all red candles before a green candle finally appears. So what is the price action psychology behind this? The consecutive red candles shows a continuation of selling presence before a green candle appears, which shows a loss of momentum from the sellers as price failed to close the candle with a lower candle close. So next, the momentum candle. This is where the candle body size is much larger than the previous candle, which represents a heavy gain of momentum. Now, on the charts. So starting with an uptrend, you first need to identify a short trade setup at resistance. Now, some traders will take a trade short right away after the inverted long wick candle forms here, which is fine. But a more secure entry is to wait and see if you get a momentum candle to form like this after the trade setup. Then you would take a continuation trade short. So what is the price action psychology behind this pattern? The momentum candle confirms that a lot of sellers actually stepped into the market at the level, creating the heavy bearish momentum and thus causing the massive momentum candle to form. Now, in the opposite direction. You first need to identify a long trade setup at support, such as this one right here through the long wick candle. Now, right after the long trade setup occurs is when you would look for this momentum candle to form. So what is the price action psychology behind this? The momentum candle confirms that a lot of buyers actually stepped into the market at the level, creating heavy bullish momentum and thus causing the massive momentum candle to form. Now, as a reminder, don't forget that there is a massive, highly detailed Candlestick Patterns trading guide that works in combination with this video and is required to fully grasp these advanced concepts. So now that we've covered the candlestick patterns we look for, let's get into how to actually use these patterns through a variation of entry methods. So, a question we often get asked is, how do you trade with candlesticks in bullish, bearish, and in sideways markets? We always read the comments to decide the next videos we plan on making. So right now, go to the comments below and tell us exactly what topics you want us to cover next. So here's the core formula of the strategy. And here are the variations of the strategy we'll be going through. Now, for this section, we are only using one time frame to keep it simple. So, starting with the first, which is a trend trade in an uptrend. Here is the anatomy of the trade setup. So, let's show this right on the charts. You have your clear moving uptrend through the higher highs and higher lows. So you want to trade with the moving uptrend. This here was your area of confluence and where the trade opportunity presented itself because of the following factors. Key support level, the moving average that crossed right at the same area, and the 61.8% fib level. Now, as price came back down, you were looking for any of the candles we covered to form at the area of confluence to show a reaction to the level. In this case here, the candles you had that formed is multiple long wick candles and an inverted long wick candle. Again, it could have been any of these candle patterns that formed, as it would work the same. Now, a reaction does not equal an automatic trade long, as price can stall at the area of confluence and still break right through. Because even though your big picture trend is an uptrend, your immediate trend is a downtrend, and price can stall at the area and then still break right through and trigger a larger trend change. And this is why you need the trend change confirmation after the candlesticks form and react to the key level to show that the short-term downtrend is over and that the larger uptrend can continue. If only using one time frame, you wait and see if you get a momentum and follow through candle to form like this here, which shows that heavy buying presence has actually entered the market at the area of confluence. And then that is when you would take a long trade entry. So going in the opposite direction, a trend trade in a downtrend. Here is the anatomy of the variation. Now on the charts, clear moving downtrend through the lower highs and lower lows. This here is your area of confluence and where the trade opportunity presented itself. As price came back up to this level, you were looking for any of the candlestick patterns to form at the area of confluence. And in this case, you had an inverted long wick candle form, followed by a momentum candle, which shows a reaction to the level. This setup here allowed for a trend line to be placed like this. And once the trend line broke, the reversal is confirmed, and you would then take a trade entry short. So one more example. This was a short trade entry on the Pinterest stock. During the recent market decline, we were strictly looking for short trade entries to trade with the bearish market sentiment. So you had your moving downtrend through the lower highs before a descending triangle pattern formed. Price then broke below the pattern, showing a trend continuation of the downtrend and bearish market sentiment. This here was your area of confluence and where the trade opportunity short occurred. As price pulled back up to this area of confluence, you had your long wick candle form, which shows a reaction to the area. Again, you either take a short trade after the bearish momentum candle, or the preferred method would be to look for an intraday trend change, an intraday entry short, using our entry strategy and tool. So next, a reversal trade in an uptrend. Here is the anatomy of the variation. So let's show this right on the charts. You have your key level of resistance because of this reversal point here. As price approached the level, you had shrinking candles showing a loss of momentum from the buyers, which you like to see, especially when trading counter trend. Once price hit the level, you had perfect multiple long wick candles, which shows that price tried over and over and over again to push through the level but failed, showing that the resistance level held strong and that it is valid this time around. You then needed a trend change confirmation, which you got in two parts. First, you had candles that were increasing in size, showing heavy bearish momentum had entered the market. And two, to cap it off, you had a momentum candle break through the trend line. All of this signals a confirmation of the reversal from an uptrend to a downtrend. At this point here is when you would take a trade entry short, so going in the opposite direction. A reversal trade in a downtrend. Here is the anatomy of the variation. Now on the charts, you have your key level of support because of these two reversal points here. As price reached the level, you had multiple long wick candles, including a very long wick candle. This setup here allowed for a trend line to be placed like this. Once you had your breakthrough and above here, the reversal is confirmed, and then that is when you would take a long trade entry. So next, a reversal continuation trade in an uptrend. Here is the anatomy of the variation. Now on the charts, you first had your moving uptrend before a double top formed, followed by a break of the neckline, confirming the reversal from an uptrend to a downtrend. So your traditional reversal entry took place up here, but this second entry here acts as another way to get into the reversal trade and is a more secure way to do so because price has already formed the lower low here and you would be riding the momentum of the fresh trend change. Now as price pulled back, you had multiple long wick candles react to the new level of resistance that formed. Trend line placed below like this, and once you had your break, the reversal is confirmed and you would then take a trade entry short. Now going in the opposite direction, a reversal continuation trade in a downtrend. Here is the anatomy of the variation. Now on the charts, you first had your moving downtrend before a double bottom formed, followed by a break of the neckline, confirming the reversal from a downtrend to an uptrend. Now as price pulled back, you had shrinking candles followed by a long wick candle. So in terms of the trend change confirmation, option 1, wait for a confirmation candle pattern, such as these candles increasing in size. But the issue is you are getting in all the way up here, which can be a bit late to the trade as it has already moved a bit. So how do we get around this problem? This leads us perfectly into our next topic, which is the usage of multi-timeframes, which allows you to find an intraday trend change right after you had the candlesticks form at your trade opportunity area. So let's get into it. Now, as a reminder, don't forget that there is a massive, highly detailed Candlestick Patterns trading guide that works in combination with this video that goes through a lot of content and detail that we don't have enough time to cover all in this video. Also, if you are enjoying this video and want to support our team, hit the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. Now here's the core formula, combined with the use of multi-time frames. And here are the core variations of the strategy. So starting with the first, which is a trend trade in an uptrend using multi-time frames. So again, you had your uptrend and your trade opportunity long at this area of confluence here. You then had your multiple long wick candles reacting to the area of confluence. Now, the trend change confirmation came from this momentum candle here, meaning you wouldn't have been able to get into this trade long until after this momentum candle closed up here. And this is why you would want to use multi-time frames, which is to get into this trade at an earlier entry point. Meaning, after you had the candlesticks form here, you would go to a lower intraday time frame and find price action that signals a trend change from a downtrend to an uptrend and get into this trade at an earlier point. So let's pull up a lower time frame and put it beside this one. The chart on the left is the 6-hour time frame we just looked at, meaning every candlestick represents 6 hours of time. The chart on the right is the same asset but using the 30-minute time frame, meaning every candlestick represents 30 minutes of time. Same key level, same pullback, same area of confluence. Now, notice how on the 30-minute time frame on the right, you can see so much more detail and can actually see the swings of price in comparison to the 6-hour time frame on the left. So again, after you had these long wick candles react to the area of confluence, you were looking for any form of price action that signaled a trend change from a downtrend to an uptrend. And in this case here, here's what you had. The double bottom form right at the key support level and inside of the long wick candles from the higher time frame. Trend line placed above, connecting the swing highs. Then once price broke through the trend line and formed a clear higher high with momentum, this confirms the reversal from a downtrend to an uptrend, and you would take a long entry on the same time frame or on an even lower time frame using our entry strategy and tool. So again, why are we using multi-time frames? If you only used the higher time frame on the left, you got in at the top of this candle here, which is roughly right here on the lower time frame. Where in contrast, by using this lower time frame on the right for an entry, you were able to get into the trade down here, which is at an earlier point. So what are the benefits of getting in at an earlier point? 1. You were able to capture a larger portion of the move before the trend moves too far and starts suffering from trend exhaustion and potentially pulls back or reverses completely. And 2. An earlier entry point means more profit as you're capturing a larger portion of the move. So now, going in the opposite direction. A trend trade in a downtrend using multi-time frames. So on the left is the 8-hour time frame. You had your moving downtrend and your short trade opportunity right here at the area of confluence. Once price pulled back to the area, you had a candle color change and one where the wick is sticking out. That's when you would look inside for a trend change and use a lower time frame such as the one on the right, which is the 2-hour time frame. Same key level, same pullback, same area of confluence. Again, we were looking inside of this candlestick pattern on the lower time frame for price action that signaled a trend change from an uptrend to a downtrend. And here's what you had. First, this can be viewed as a form of double top, which is a reversal pattern. Or if you work off of candle closes, this is a full trend change pattern, as you have your lower high and then your lower low, and combined with a bearish momentum candle, which all confirms the reversal, and is when you would start looking for trade entries short on the same time frame or through a lower time frame using our entry strategy. If you only used the higher time frame on the left, you wouldn't have started looking for short entries until this bearish momentum candle formed, which is roughly down here on the 2-hour time frame. In contrast, by using the lower 2-hour time frame to find an entry, you started looking for short entries up here, which is an earlier point and is a huge advantage. So next, a reversal trade in an uptrend using multi-time frames. So on the left is the 6-hour time frame. You had your key level of resistance because of this reversal point here. And this is where your reversal trade opportunity short presented itself, and is where you had an inside bar pattern form at the key level. So then on the right is the 30-minute time frame that was used for an entry point. Same key level, same pullback. This area here is this same area here. Now on the 30-minute time frame, you can place a trend line like this due to the swings of price being visible, where you couldn't do that on the 6-hour time frame on the left. After the trend line was breached, you started looking for trade entries short in this area here, where if you only used the 6-hour time frame on the left, you wouldn't start looking for entries until after this bearish momentum candle closed here, which is roughly down here on the right lower time frame. So going in the opposite direction, a reversal trade in a downtrend using multi time frames. So on the left is the 4-hour time frame. You had your key level of support because of this reversal point. And this is where your reversal trade opportunity long presented itself, and it's where you had multiple long wick candles form at the level. So then on the right is the 1-hour time frame that was used for an entry point. Same key level, same pullback. This area here is this same area here. Now, if you use candle closes for your analysis, this is the lower low, whereas the RSI makes a higher low, which formed a divergence and is an early signal of a possible trend change from a downtrend to an uptrend. This can also be viewed as a double bottom, which is a reversal pattern. Neckline placed at the recent swing high here, and once price breaks above and makes a higher high, it confirms both the double bottom reversal and the divergence reversal, which makes this a higher quality trade. Again, if you only used the 4-hour time frame on the left for your entry, you wouldn't have started looking for long trades until after this bullish momentum candle closed up here, which is roughly up here on the lower time frame. In contrast, by using the lower 1-hour time frame, you started looking for long trades all the way down here, which is a huge advantage. So now, the final two types of entries. The reversal trade continuation entry in an uptrend using multi-time frames, and the reversal trade continuation entry in a downtrend using multi-time frames. These work the same like we previously showed you when using only one time frame, except now just apply the multi-time frame on top. We don't want to get too repetitive, so moving on to the next topic. Now, before we continue, we have a very important question we need you to answer. Do you prefer videos with a white background, like the one we are using in this video, or would you prefer a black background, like the ones we use in all our past videos? Comment below right now and tell us which background color you prefer. Also, if you're enjoying this video, please hit the like button, subscribe, and turn on the notifications bell so that you know exactly when we release new content. The last thing, make sure you go follow our Instagram account at WiseTrade to stay notified about a lot of big projects we have on the way. So what are false candles and false reversals? Let's break it down. You had your key level of support because of this reversal point. Once price reached the level, you had multiple very long wick candles form at the key support level, and you thought to yourself, this is a great long trade opportunity. I'm going to open a long trade right away and make a fortune. Then what happens? Price breaks through with momentum and you lose your money. This was a false reversal, also known as a fake out or a trap. So why does this happen? Amateur traders who don't wait for a trend change confirmation will enter right away after the candle patterns form at the level here. And they will often place their stop losses up tight and in this area here below the candle. If heavy selling presence then enters the market, whether it be regular or manipulated, all those stop losses placed close by below all get triggered at once, which results in all those long positions that were just opened at the level being closed all at once. This is what causes the heavy momentum candle to form right after, which is a result of all those premature long positions that were just opened at the level being no more. So how do we get around this problem? You should already know the answer by now. 1. Always wait and see if you get price action that signals an actual reversal of price. And 2. After the reversal is confirmed, you need to find an actual key entry point that maximizes gains and limits risk. So let's pull up a lower time frame, specifically the 1 hour time frame, to look inside of where the candlestick patterns formed here to show you how everyone got trapped. Now on the left is the 6 hour time frame we just looked at, and on the right is the same asset but the 1 hour time frame. Same key level, same downtrend. This area here where the candlesticks formed is this same area here. Now, notice how on this lower time frame you had a perfect descending triangle pattern that formed. Price broke below the pattern, which is price action that signals a trend continuation of a downtrend. There was zero price action that signaled a reversal, and zero price action that confirmed the long wick candles from the higher time frame, meaning there was no trade long. For you to consider a long trade entry against the strong downtrend, you would need two things. 1. A break above the pattern and a higher high, and 2. After you had the trend change confirmation, to go to the even lower time frames to identify a precision entry point that maximizes gains and limits risk. So let's show this again. This is the Twitter stock that we took multiple short trade entries on along the way down, starting from when the lower high here formed. But now, let's say you were considering looking for stocks to buy and adding to your portfolio at a discounted price during this market decline. Here's what you saw. You had clear, heavy bearish momentum without a green candle ever appearing, which is already a bad sign if looking for long positions, especially when going counter trend. You noticed this very key level here because of these two reversal points. When price reached the level, you had this small candle with the wick sticking out, which shows a reaction. Again, if you decided to automatically go long, you would have been trapped as price continued down. So let's pull up the daily time frame to look inside of the candle and why this long setup failed. On the left is the monthly time frame we just looked at, and on the right is the daily time frame. Same key level, same downtrend. This area here, where the candlestick formed, is this same area here. You had a descending triangle that then breaks below, which shows more bearish momentum and a continuation of the downtrend. Before even considering a counter trend entry against a very strong downtrend, you would have wanted things like a green candle to appear or multiple long wick candles to form on the higher monthly time frame on the left. Then a break above the pattern here and a higher high on the daily. And then, after all that, based on the price action setup, begin considering a long entry through the lower intraday timeframes. Also, as a bonus, for those trading with the moving downtrend, this here actually presented another short trade opportunity for you through the pullback to the broken pattern bottom. So one more example. This is the Coinbase stock. Now let's first establish what gave us our bearish bias, starting on the weekly time frame. You had your moving uptrend with all green candles before a red candle finally appears, which shows a loss of momentum from the buyers in the market. So let's pull up the daily time frame. So this area here on the Coinbase weekly time frame we just looked at is this same area here on the Coinbase daily time frame. You again had bearish price action through the lower high that formed and a lower low that formed, which represents a fully formed trend change from an uptrend to a downtrend. This is also a descending triangle pattern before price broke below, which is again a reversal pattern from an uptrend to a downtrend. So we were strictly looking for short trades to trade with this new bearish momentum. And one of many entries that we took along the way down occurred right here, where the long wick candle pulled back to the bottom of the descending triangle to the trend line, which presented a great short trade. Now back to the larger topic. Let's jump back to the weekly. Again, we established that we have bearish momentum. So figuratively speaking, let's say you are a value investor looking for stocks to buy to add to your portfolio at a discounted price during this market decline. You spotted this key support level here due to these multiple reaction points. As price reached the level, you had a green candle with the wick sticking out. Again, if you decided to automatically go long against the strong downtrend, simply because you had candlesticks at a key level, you would have been trapped as price continued down. So let's pull up the 4-hour time frame to look inside of these candles and why this long setup failed. On the left is the weekly time frame we just looked at, and on the right is the 4-hour time frame. Same key level, same downtrend. This area here, where the candlesticks formed, is this same area here. All you had on this time frame was your falling wedge, and without a break above, and without a break of the trend line, and without a higher high, there was no price action that signaled a reversal from a downtrend to an uptrend. Price instead gapped below the falling wedge and below the very key level, signaling a trend continuation down. Now, moving on to the most important topic of this video. Imperfect trades are when there are multiple key levels close together, which creates a zone, and you are taking a trade in the general zone and area. Let's break it down. So notice to the left, you would have two key levels drawn in, level 1 here and level 2 here. These are two very different and distinct key levels. And here's the problem. Since these levels are close by to each other, as price is approaching these levels, you are thinking to yourself, should I look for candlestick patterns at this first level, or should I look for candlestick patterns at the second level? Having multiple levels drawn in close by to each other can cause confusion and analysis paralysis. Now, to get around this problem, instead of drawing in multiple levels, what you do is you draw in a wide zone like this and treat the zone as a general area where you look for candlestick patterns to form within or around. This is very important. Candlesticks don't have to form exactly within the zone. They can form slightly past it as well. Because again, you are treating it as a general area where you are looking for candlestick patterns to form. So then, as price pulled back here and entered the zone, you had the long wick candle form inside of the wide zone and area, which shows a reaction. And that's why we call this an imperfect trade entry, because the candlestick pattern forms in the general area where key levels are stacked. So as always, we need a trend change confirmation. So let's pull up a lower time frame, specifically the 4-hour time frame, and put it beside this one. On the left is the 12-hour time frame we just looked at, and on the right is the 4-hour time frame of the same asset. Same key level, same downtrend. This area here is the same area here. Now, on this lower 4-hour time frame on the right, you had your trend line placed above, and once price breaks, this confirms the trend change from a downtrend to an uptrend, and you would start looking for trade entries long through the lower intraday time frames. So let's show this again. To the left, level 1 is here, level 2 is here. These are two very clear and distinct different key levels, but they are close by to one another. So again, instead of having two levels drawn in and causing paralysis and confusion, create a wide zone and look for candlestick patterns to form in that wide zone and area, followed by a trend change confirmation. So as price came into this area, here's what you had. Multiple long wick candles reacting to the area, and then a candle color change. So let's pull up a lower time frame, specifically the 30-minute time frame, and put it beside this one. On the left is the 2-hour time frame we just looked at, and on the right is the 30-minute time frame of the same asset. Same key level, same downtrend. This area here is this same area here. So inside of the candlesticks, you had a perfect symmetrical triangle form, and once price breaks above with bullish momentum, the trend change is confirmed and is when you would start looking for long trade entries through the even lower intraday timeframes. So next, to the left, you have your level 1 here and your level 2 here. Again, instead of having two separate levels, we remove them and create a zone. This is a very key area because price reacted to the area as both a support area and a resistance area. So as price entered the key area, here's what you had. A very long wick candle, and then a candle color change. So let's pull up a lower time frame, specifically the 30-minute time frame, and put it beside this one. On the left is the 4-hour time frame we just looked at, and on the right is the 30-minute time frame of the same asset, same key level, same uptrend. This area here is this same area here. So inside of the candlesticks, you could have viewed this as a head and shoulders pattern or a channel pattern. Regardless of which one you use, neckline and support line placed below, and once you had this bearish momentum candle break through, reversal confirmed, and then you would look for short trade entries through the even lower intraday timeframes. Now, here's a very key point about taking imperfect entries. You don't have to trade zones and imperfect trade entries. You can be a more conservative trader and only look for trade setups at a clear, distinct support and resistance level, which is perfectly fine. Our job is to provide you with all the tools, and you as a trader should pick and choose what works best for you, based on your trading style and your risk tolerance. There is no right or wrong style of trading, as long as what you do makes you money. That's it. So one more example of an imperfect entry. To the left, level 1 here and level 2 here. This is clearly a very key level because it is an extreme swing high, meaning the highest point that price has reached in recent time, and price reacted to the level every time price touched it without being able to push through. Now, this is a great example of why you are treating it as an area, because notice how price breaks slightly above. An amateur trader would then think this invalidates the short trade, where a more experienced trader, like you are now, knows that if you get an intraday trend change, this short trade is still on the table. Remember that you are looking for candlestick patterns to form in the general area. It doesn't have to be within the zone you created. It can go slightly past as well. This break above is also known as a false breakout, and amateur breakout traders all got trapped into long breakout trades. Now, as price entered the area, you had multiple candles with the wicks sticking out in both directions, which shows a reaction and indecision at the area. As always, we need a trend change confirmation. So let's pull up a lower time frame, specifically the 2-hour time frame, and put it beside this one. On the left is the 8-hour time frame we just looked at, and on the right is the 2-hour time frame of the same asset. Same key level, same uptrend. This area here is this same area here. So inside of the candlesticks, you had a perfect rising wedge form. Once price breaks below with a bearish momentum candle, trend change confirmed, and is when you would start looking for short trades through the even lower intraday timeframes. Now, while on the topic of imperfect trading and trading zones and areas, we want to show you something interesting that occurred on Bitcoin before it crashed. So, as you already know, Bitcoin and the crypto market as a whole has recently experienced a market dip. Before this reversal occurred, if you were watching the higher time frame levels, you would have noticed a few interesting things. So let's break it down. This is the Bitcoin monthly time frame. You had this very key level and area, so you would have had a zone drawn in like this. From our past videos, you should know that things you find on the higher time frames hold more weight, especially when found on the monthly time frame. The reason for this is because monthly price action and monthly key levels are very slow to form. So when they do form, or to be more specific, when they are visible and visually obvious on the monthly time frame, they represent very, very key levels to watch for. This area was also an all-time high area, which again shows how key this level and area is. As price came up to this level, you had multiple long wick candles reacting to the general key area and zone. Now, we're not saying you should have shorted Bitcoin, but if you were a holder who was running with a very large profit and with many large positions, whether directly through Bitcoin or a correlated crypto asset, this would be a good time to consider closing out positions to lock in profits and then wait for another possible future entry point. So the initial reversal here shows you roughly where a lot of whales initially took profit, causing the drastic dip. Then this second move back up to the all-time high price acted as a second chance for traders to close long positions, as now they know where the parameters of the playing field are. Now let's pull up the weekly time frame and put it beside this one. On the left is the Bitcoin monthly time frame we just looked at, and on the right is the Bitcoin weekly time frame. Same key level and area, same uptrend. This area here is this same area here. Again, notice how on the weekly time frame, price broke out slightly above, making this an imperfect area. If you didn't close out your positions based on the monthly time frame price action and monthly key levels, a second exit confirmation point would have been through the trendline break area here. Now, to be clear, No one could have predicted this drastic reversal here. In an alternate timeline within the multiverse, this could have ended up being a slight pullback and then price continued up and to the moon. But as traders and investors, your job isn't to only look for high quality entries and then hold those positions until the end of time. The other half of the job is to identify great areas to consider taking profit, to not only pull money out of the market, but also to limit risk exposure. Now, what we've covered today is only scratching the surface. On our website at wisetrade.com, we have a massive Candlestick Patterns master guide that is required to have in order to fully grasp all these concepts we have discussed in this video. It goes through things like exactly how to enter and exit trades, profit targets, stop loss placement, and stop loss management, how to manage winning positions, scaling into winning positions, scaling out of winning positions, and so much more we cannot cover all in this video as it would be way too long. So again, go to wisetrade.com to get access to everything right away. Now again, we need the answer to this question right now. Do you prefer videos with a white background, like the one you saw today, or do you prefer videos with a black background, like the one we used in all our past videos? Tell us in the comments below right now. Also, if you enjoyed this video and found it helpful and want to support our team, please hit the like button, subscribe, and turn on the notifications bell so that you know exactly when we release new content. The last thing, make sure to go follow us on our Instagram account at WiseTrade to stay notified about a lot of big projects we have on the way. So thanks for watching, and I'll see you in the next episode.